listening to the Spicy Dividend. Hey, what's up, everyone? Today, March 20th, 2020. Black Friday. I think I might have called this in yesterday's podcast saying that I would not doubt if we have a Black Friday where things just tank today, and they did. So the news came out that oil was pretty much under $20 a barrel. I believe that's what came out, and the rest of the market just followed. It started out as what seemed to be a promising day. The S&P at one point was up 2%, and it finishes on a negative 6% swing. It finishes down 1,000 plus points, down 4.2%. The Dow Jones Industrial Average down 900 points, 4.5%. It's just another bloody day. And if you've been following the market for the past month, this is pretty much business as usual at this point. I mean, there's nothing really too surprising about a day like today. There's still violent volatility, a lot of uncertainty. And as numbers come out, there really is no telling if things are going to get better, flatline, or just get worse. So any thoughts of the market kind of leveling off and tapering? Those hopes might have got dashed pretty quickly today. On the flip side, if you remember me buying Penn National Gaming for $4.50 a share, at one point it was up $11. I was up over 100% on that tranche in under 2 days. The stock ended at a price of $7.78, so still on the $4.50 tranche, I'm doing great, but I'm still overall down on that position because I originally bought at $9.90 and $9.10, so still down a little bit on that position. So let's talk a little bit about my strategy going forward and from here on out. So if you're new to the podcast, welcome. Thank you very much for listening to the Spicy Dividend. My name is Scott, and you can follow me on Twitter at DGenDividends. Everything's in the description below, or you can leave comments on YouTube if you're listening there. So when I started my whole social stock market journey, if you want to call it that, back in late 2017, I started at $350. I grinded my ass through YouTube and a whole bunch of other side hustles. Got it all the way up to 51,000, where it was at the end of February-ish. I completely lost I lost $10,000 on a 13K bet on Berkshire Hathaway. Really stupid of me. So went down to 40,000 there. I panicked. I took out 30K from mine and just put it into my wife and I's mutual high interest savings account, which isn't that high yielding anymore, but I put it into our mutual savings account where it can't lose any money. To then I was about, I was at like the $10,000 range, and I lost a little bit here and there just doing miscellaneous stuff. I took out about another $2,000 just to put in my own personal checking account, just because I wanted to have some fun. I figured if I'm going to lose all 50K out of that portfolio, I'm going to have some fun. So I'd saved $2,000 out of that, still in my checking account right now. And then I did another $2,000 on sports gambling. So my portfolio is absolutely decimated at this point. So I'm at the point of rebuilding my personal individual portfolio back up. Now, there might be a point where my wife and I decide let's get some of our mutual fund into equities when we decide the market's at a really low point, really juicy entry point. At this time, it's much too risky for something that we consider our emergency fund. I'm happy to report that we put so much into this emergency fund that if both of us were to get laid off, we're covered for 3.5 to 4 years. So we've done a really good job. We're on the same page with the conservative financials, really spending it up. I'm saving $200 every single week and putting it in our mutual savings account. So it's an awesome emergency fund, rainy day fund, maybe a future house fund, so on and so forth. So that being said, I'm building up my individual position again, and it's not going to be nearly as fast. I'm trying very hard to get my side hustles back up, but one of the most idiotic things I did was pretty much just disband my old style of YouTube videos, and that was probably the most idiotic move I can make. I lost a lot of my side hustle income, and not only that, but I believe me putting out that I was in the dividend niche permanently pretty much force my hand in terms of investments. And, why would you do something as stupid as a $13,000 option call expiring in 3 weeks? If I was just following my bread and butter with dividend investing and stuck to my YouTube channel, I probably would not be in the situation that I am today. But that being said, it's a harsh lesson learned. Luckily, I'm young enough, 28. I turned 29 this Sunday, actually, March 22nd. It should be fun just sitting in a damn house. But that being said, it's a harsh lesson learned. I'm young enough where I can recover as long as I work my ass off again. So I'm trying to build it up. And what is my strategy going forward? So one of the things I would like to do is take positions that are really, really cheap, or just positions that I really want to build up. So I would like to ideally limit my portfolio to about 10 holdings. And the 10 holdings that I would like include the likes of ones that I know for sure are a VNQ, which is Vanguard's real estate ETF, VIG, Vanguard's dividend appreciation ETF. For individual equities, I would like to build up Home Depot. I would like to build up Thermo Fisher Scientific. Penn, I already have 100 shares of, and I'm going to tell you why I'm very interested in owning 100 shares of the items I'm listing. JP Morgan Chase is one that I'd like to get up there. And, there's a couple more that I haven't bought yet. And there's a couple that I've already sold that I bought this week that I'm like, you know what, this is not a position I want to build up in. I'm not sure why I bought it. And I ended up selling Discover. And I ended up selling Travelers Insurance. But, Delta Airlines is one that I also would like to build up. And I'd like to build up these positions if I could. It's going to be tough with Thermo Fisher Scientific just because it's so expensive. Build these positions up to at least 100 shares and kind of make my own dividend by doing so. Now, what do I mean by that? Excuse me while I take a sip here. Oh, Pepsi's good. Don't let my parents hear that. My dad works at Coke. I worked at Coke. My sister works at Coke. Anyway, I would like to start selling covered calls and get a little bit of income. Buy these shares while they're cheap. Build it up to 100 shares as quick as possible and do some covered calls. So if you're completely brand new or you have no idea what I'm talking about, when you own 100 shares, minimum of 100 shares of a certain position, and the position has options trading on it, what you can do is you can sell a call. So let's just say a theoretical position is trading for $100. What you can do is you can sell an out-of-the-money call at with a strike of $115, right? Something that's above it. And you collect the premium, what it's called, for selling that option. So what ends up happening is your 100 shares that you own, or at 100 shares for every contract that you sell, is locked. And then come expiration date, if the price of the share that you are selling a contract on does not reach that strike price, so 115, let's say it goes to 110 at whatever date it expires, you just keep the premium and then you keep your 100 shares. So it's as simple as that. The downside to this is if you try to get really aggressive, or if the stock really spikes really fast in price, you could end up getting your calls exercised and you end up losing your 100 shares. But the cool thing about it is that even if you were to lose your shares, you still reap the profit of both the premium and selling 100 shares at that certain price. So if you bought it at 100, right, your cost basis is 100, and you end up selling these out of the money calls and they go way past 115 before expiration happens and they end up getting exercised, well, you still get the benefit of that 100 cost basis going up to 115 along with the premium that you sold and you gathered when selling. So you will be profitable. It's not like you lose all your money. You just lose the shares. And, if they go back down, you can just repeat the process. That's something that I really am interested in doing on. And today I boosted my position in Penn just to get it to 100 shares. I was at 85. I bought 15. It was very cheap today. I only had to pay like 80 some dollars just to get my boost up to 100 shares. So I will be selling covered calls on Penn. I will be letting everyone know on here how it goes. It's something that I want to do with all the positions that I'm building up. Eventually build all my positions up to 100 shares where I can sell some options and make some money along the way. Now, some options are a lot more liquid than others. They sell for higher premiums than others. Some of them are weekly, some of them are only monthly, and some might not have options at all. So if your strategy is like mine and you want to sell covered calls, you just have to be aware that there might be some equities out there that you really like that don't have this option at all. They don't typically sell options. There's no contracts out there available. So it's just something to keep in mind, especially if you're an ETF. Now, if you do like SPY or the Dow Jones Industrial, DIA, stuff like that will always have options. And the cool thing is if you own 100 shares of SPY, SPY, the S&P 500 ETF, is that they have options that expire every 2 days, Monday, Wednesday, Friday, Monday, Wednesday, Friday. So you could ultimately repeat this process very quickly. And this is something that I honestly would like to look in myself. So SPY might be the one. And again, this will be very difficult because it's at $200 plus a share. But if I could somehow get 100 shares of SPY and then start doing covered calls that expire in 2 days and just keep ramping up the income as quick as possible, sell completely out of the money positions that'll never hit, yet you still can collect a premium and your shares are safe, that might be something worth looking into. Now, that's going to be way, way, way down the line because let's do the math here. So let me get out the calculator. What did it end at today? SPY, we're going to say it ended at 228. 228, if you need 100 shares of that, you're going to end up spending $22,800 just for that position. But if you can get there, and I'm an idiot because I could have gotten there with my money from the past, but you get the 22.8 and you just sell covered calls that expire every 2 days and you just keep rinsing and repeating. Now, again, you might have to, it's not going to be 3 times a week. You're going to end up probably doing it 2 times a week if you do it over the weekend and then sell for Friday. But again, you can do it 3 times a week. Just get that money. It's not going to be, anything crazy, but you can end up earning anywhere from 1 to 10% a year doing this, depending on how aggressive you get. So definitely something that I am going to be looking into with some of my positions. If you follow me on Twitter, which is at DGenDividends, you saw that I'm very interested in Ford right now. They just cut their dividend completely, so this is not a dividend play. And if you are an owner of Ford for dividends, just keep in mind they did cut their dividend. Maybe you weren't able to read the news or anything lately, but they cut their dividend completely. Who knows if they'll bring it back or when they'll bring it back and so on and so forth. Now, look, I said that I would like to buy 100 shares if it goes below $4 because look, 100 shares times $4, that's $400. Very cheap. It's a very good introductory way to get into covered calls. That's why I'm glad I got Penn so cheap. So if I can get it at $4, 100 shares, obviously the option premiums aren't that juicy on Ford, but nonetheless you can get some good practice on selling. And the cool thing about Ford versus something like Penn is that Ford does weeklies and Penn only does monthlies. So Ford, you could theoretically sell covered calls every single week and make some money. So that is what I would like to do with my portfolio. Gather way less positions than I've had in the past and build them up to the point where I can start selling some covered calls. So, I'm back on the podcast hustle, trying to do it every single weekday, Monday to Friday. Who knows? Maybe I'll throw out a couple Sunday episodes in there as well. Build up some equity. Any money that I do get from the podcast, which is not much, let me reiterate that. And if people start listening on YouTube again, and if I get any ad revenue from that, like I said, it's all going to the portfolio again. In the past, if you're new to the podcast or if you're new to the YouTube channel, I used to I used to put in a minimum of $30 every single trading day into my individual portfolio. That's a lot of money, okay? And now let me emphasize again, minimum $30. But now that I switched my mentality, I'm putting $200 a week into my wife and I's high yield savings account. Obviously, $30 a day is just not realistic. I don't make nearly enough money. I'm nowhere close to six digits. Okay, nowhere close to 80K, to be honest. But I have a debt-free lifestyle. Like now, I'm very fortunate that I got a full ride in college, and I paid off my car in a year. So I'm saving as much as I can. I'm going to be building up my portfolio as quickly as possible, thanks in part to any side hustles that I can do. And I'm looking to get 100 shares. So we'll see how it goes. If anyone has any comments, or if they tried covered calls in the past, or if they have any other suggestions of what they're trying to do for building up during this period, let me know down in the comments. If you're on YouTube, you can let me know at Twitter at DGenDividends. Everything's in the description if you're following a podcast. Thank you if you're listening. Google Podcast, Apple Podcast, Spotify, wherever it is you're listening on YouTube. Thank you so much for giving me the time of day. March 20th, 2020. It's 4:30 p.m. on a Black Friday. Thank you so much for listening. Enjoy the most likely locked down weekend.